Anything exciting this weekend?
All always. It's gonna be fireworks extravaganza.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Everybody, I want to welcome everyone to the Capital Gains Tax Solutions Deferred Sales Trust Mastermind, where we're making all things simple when it comes to exiting your highly appreciated assets. We really feel that if you have a good plan in place and you are prepared and know your options, you can create and preserve more wealth and have some transformational ways to retire, to spend time with your family, to start that next business venture. If it's for your client, you're helping them escape feeling trapped by the capital gains tax solutions, 1031 exchange, shotgun wedding, where you're rushing around looking for low cap rate environment deals with increasing interest rates and putting people in a position where maybe they're not going to be sitting too well in a year or two or three. And in fact, that was my story in 2008. I saw the marketplace fall apart in Sacramento, California, helping clients who were trapped by the 1031 in 05, 06, 07, just to see half of their wealth to everything lost in the next 3 years on these projects where they had too much debt, not enough liquidity, not enough diversification. And I was just a regular multifamily broker, just trying to help people out when I learned about the Deferred Sales Trust. And now I've had a chance to study and see what it can do for my clients. We close about a deal a week, which is part of what we're going to be talking about here. And my goal is to try to make this as simple as I can with the Deferred Sales Trust so that you can feel empowered. There's some real three main objections that we get all the time. Hey, this sounds too good to be true. How do I know it's legal? Hey, it seems like I give all this control and I don't have any ability to get back into my own deals. And number three, it just seems so expensive. How do I make sense of that? We're going to be covering and weaving those three kind of themes in throughout this webinar, throughout this discussion, throughout this mastermind. And I can't do it without my one of my business partners, financial advisor extraordinaire, Jake Miller. Jake, how are we doing today?
Doing well. It's a wonderful day. Glad to be here. Thank you, Brett.
And where's here for you today? Are you in the lovely state of Utah? Are you in Mexico? Where are you traveling at right now?
Today, I am fortunate to be in my office here in Utah, and the weather is fantastic. It rained this morning, so you've got the mountains in the distance, you got the beautiful sky, and you've got a summertime cool breeze that is just making life great.
Fantastic. And for those who don't know who Jake, we call him the CPA Whisperer. He's a financial advisor extraordinaire. And that's part of the team with the Deferred Sales Trust. You want a financial advisor, you have a trustee, that's our role, and then you have the client who's selling. And it takes each of us being independent to keep some accountability, but also to make sure we keep the integrity of the entire structure, which we have our tax attorneys that do the work for the legal work. That being said, Jake, you want to give a little bit more about the vision and some of the things that people can learn today?
Absolutely. The reason we are here today is we all know somebody, or ourselves possibly, are having a highly appreciated asset sale, something that would otherwise trigger a very big tax event. And we're talking about ways to mitigate that and how the Deferred Sales Trust might be the keystone tool that can either solve the entire situation itself, or combined with other strategies based on your circumstance, can help you defer those taxes going forward, reinvest the gross proceeds in other assets, doesn't have to meet any like-kind rules, but be able to move forward investing net of attorney fees rather than net of taxes, and overall increase your net worth.
Perfect. We know there's Strategic Alliance. He's also one of the co-hosts at the Capital Gains Tax Solutions, Pierce York. Hey, Pierce, I'm curious, who does this work for and who doesn't it work for?
Hey, Brett. Thanks for the intro. Yeah, guys. So this works for anybody who is selling a highly appreciated asset. There has to be a transaction with at least $1 million gain and $1 million net proceeds, or a combination of two deals or so that kind of equal that that threshold.
Why is that, Pierce?
So there's a specific amount of pain that is kind of required. Brett, you mentioned one of the main objections that we get is, this sounds too good to be true. What's the catch? And I believe the catch is that, each person's individual circumstances can be complicated. And there's a process that we have to go through of getting to know us and us getting to know your professional teams and getting them educated and on board. And so there's a process you have to go through. And, I think that it requires a certain amount of pain. If you have a property that you sell, or business, or a stock, or a crypto that you sell, and you're only, and you sell it for, $100,000 and you bought it for 10, and you have, a $30,000 gain, I mean, that might be painful, but it might not be worth going through the process, and it might not pencil with the fees and everything. But if you have a property you bought for $100,000 and you're selling it for $2 million, well, now you have, a $1.9 million gain, which is around, quick math, around a $600,000 tax if you're in California, or maybe a little bit less if you're in a state that doesn't have income tax. Then it's definitely worth your time, because you're going to save a significant chunk that you can then redeploy, earn interest on, take dividends from, and it's just an all around much better deal. So that's why we kind of put those thresholds in.
Yeah, it makes sense, Pierce. That's a great answer. And it works for LLCs, S Corps, C Corps. It works for saving failed 1031 exchanges, as long as you're working with an accommodator who actually will accommodate and not block the Deferred Sales Trust. Be very careful. Not all accommodators want you to know about this. In fact, they want to keep you in the 1031 exchange. In fact, they put out blogs that say, Jake, Pierce, everybody, it's not accepted in California, or it's not legal, or whatever. But guess what, Jake? How many closes have there been over the years? And has there ever been a single negative result in any case over the thousands of closes, billions under management in California, Jake? What do you say to that?
You got to be aware of fake news. Literally thousands of closes, zero issues in the state of California. In fact, we're working with several clients right now. We've closed clients in the near past in California. And moving forward, helping them defer capital gains, not only federally, but also statewide. And it's not just a California thing, but all over the country. In fact, we have clients with assets that are held outside of the country And the sale of those assets would otherwise be a capital gains event for them in that country, plus also here as well, depending on the foreign income tax credit and everything else. But they've been able to enjoy the benefits of the Deferred Sales Trust here as U.S. citizens, even with property abroad. And so, 25, 26 years of experience, thousands of trusts, 22 reviews, 10 reviews, and 12 actual audits. And of those audits, one particular was in the state of California, a deep dive audit, and had to do with the sales price that was being deferred, $120 million. And everything went through just fine. No issues, no concerns, 100% representation for that transaction. And at the end of the day, client was whole. Client was happy. Client was able to reinvest the gross proceeds minus attorney fees rather than minus taxes, and continue to enjoy the overall benefits of that wealth.
Yeah, exactly right. And then that's really the key. Is the deferred sales trust legal? The answer is yes. In fact, until there's evidence that it's not, it continues to work. And thousands of closes, billions under management, lifetime audit defense provided by our business partners, who I call the Elon Musk of tax. He's brilliant. His name is Todd, and he created the structure, and it's amazing. And so it just keeps working. We keep closing. In fact, we just closed a deal in San Diego for $13 million. We closed one in Palo Alto for $8.3 million, one in Santa Cruz for $7.9 million. We've done Menlo Park. We've done San Diego. We've done Los Angeles. We've done Sacramento. We've done Oroville. We've done Cameron Park. We just keep closing deals, and we want to help you understand that it's 100% legal. It works every single time, but realize that not everyone knows how to do it, and that's the reservation, and that's okay to have those reservations. But this is part of why we work on a conditional basis, right? Meaning you don't pay us anything unless and if the deal closes. So that's why you want to come to the table, and we think of it like a Rubik's Cube. We're all just problem solvers, right? At the end of the day, we get paid for solving problems, and to the extent that we can solve and line up all of your challenges to look like this, right? Have you guys seen those quick guys where they do it in like 6 seconds? And so the goal, this left side could be, or this yellow side could be your retirement, your time and your energy. This could be, creating and preserving your wealth, starting a new business venture. This could be just retiring from the toilets, trash, and liability. This could be estate tax. Each of these sides are part of the solution for the Deferred Sales Trust. And the question is, how can it be customized, and how can you build a team to help you execute that? And that's where we come in. So that's kind of the legal part. So if anyone has any questions or thoughts about that, you're welcome to put in the chat. You're welcome to raise your hand. You're welcome to unmute yourself and ask questions about the legality, because that's really important. Because once you have that certainty of conviction that it's 100% legal and it works every time, has never failed, you can move on to the next thing. So does anyone have any questions about the legality, or any challenges for Jake, Pierce, or I on any of what we just said? And otherwise, we're like the best salesman in the world right there. That's really good. Although we don't want to sell you, we just want to educate you and help you out. So
well, I would just say that, the proper definition of sales, not the abusive definitions that a lot of us, say under our breath, what have you, but selling is just conveying value and proper communicating the definition of that value to the point that somebody else actually understands. And should they agree that it is valuable, then they're willing to buy, or they're willing to move, or they're willing to participate and take action. And that's what we're here to do, is to communicate properly so that other people understand what would normally be considered a complicated subject, but we are trying to make this simple and understandable and relevant to everyone's current situation. And again, the mission of the Deferred Sales Trust and why we're here today is to help people defer the sale, or the recognition of a sale of a highly appreciated asset, so that rather than chopping it up into little tiny pieces for the various government agencies, they can reinvest the gross proceeds of that net of attorney fees rather than net of taxes.
Absolutely. So I'm also going to be going live right now on EXP Workplace. So I'm going to welcome everyone over there. And looks like it just failed, so never mind. Forget about that. So cool. So we talked about the legality part of it. So now we also want to talk about the ability to make this an investment and not an expense, okay? And Jake touched on this a little bit, where people move out of state. They can start to receive the income from the trust slowly as they maybe have delayed the income for a year or two. When they sold, let's say in New York or California, and they moved to a place like a Florida or Tennessee or Texas, or it's a lower income tax state. The neat part about the Deferred Sales Trust and the way you make an investment, not an expense, is by establishing residency in a new state and then start to receive income in that new state, right? Because it's ordinary income tax on the interest payment. So it's kind of like if you had a big pension and you worked for the state of California or New York your whole life, and then you moved to a place like Florida, and then you start getting the pensions payments from wherever, right? Well, guess what? The ordinary income tax is in that new state. So that's a cool way to do this. Now, we have entrepreneurs that are selling businesses, and typically they're staying on for 2 or 3 years as an earnout. So part of the strategy is to delay the payment from the trust while they're still working. Now, it's still compounding and building interest, typically at 8%, but then they start to receive it over time when they make sense for them. We call that optimal timing on the tax payments. So that's a great way to make the Deferred Sales Trust an investment and not an expense. Jake, any thoughts on that?
It becomes a tool. And I mentioned it once before, but it's kind of like the keystone tool amongst several other strategies. We work with attorneys that sometimes bring their clients to the table. Sometimes they've done some initial planning before they found out about us. And occasionally they're working with, the lack of marketability. So we're going to decrease the value of the business so that we can be gifting at a lower value. And they come up with these very other complex strategies that they might still implement, but at a lesser degree based on what we're able to do with the Deferred Sales Trust. So it kind of moves up into the keystone or the main focal point of what we end up doing for the client. And then a lot of those other strategies either become unrelevant or are able to be utilized, but at a lesser degree in a more appropriate way. An example, we were talking and discussing with some people in California who had a business, and they're going to sell it for $10 million. And they were looking at the options available to them. They were considering a charitable remainder trust, and they were considering all of these things that they could do to mitigate $10 million worth of, a transaction. And at the end of the day, even though they're very charitably minded, they weren't necessarily $10 million worth of charitably minded people. They didn't necessarily want to give away everything at some point, but they did maybe want to give away 10% of that. So in the discussion, we found out that a much better plan was to utilize the Deferred Sales Trust now. And in a couple of years when the timing was better, because now they could have control over if and when they do something like that, they could do a much smaller, perhaps $1 million type of transaction for that charitable desire, rather than making it fit, the round peg into a square hole. They were able to coordinate and do things more appropriately based on their desires because they had the more flexible tool of the Deferred Sales Trust.
Yeah, very well said. And so the next thing that I like to talk about in the Deferred Sales Trust, make an investment on an expense, is the optimal timing opportunity to buy low, which is the number one thing. Like back to the 2008 crisis, and what happened was people were over concentrated in real estate, too much debt, not enough liquidity, not enough diversification, and that's where those are the people that got hurt. And so the Deferred Sales Trust, not only you can pay off all of your debt, right? So you're debt free, defer your tax, not have to over concentrate in a single asset, but then be able to buy those other assets when they go on sale, right? I mean, there's been a lot of people overpaying for properties these last few years at very low cap rates, and if some of them have adjustable rate mortgages, and guess what? Interest rates are going higher, right? And what's going to happen in a couple of years for those who were, like Warren Buffett says, when the tide goes out, you see who's been skinny dipping. Well, perhaps they're going to lose some of these properties. They're going to be some distress, and that's when you want to buy. You don't want to overpay for a property in a 1031 forced 1031 exchange marriage. You want to wait. And that's what the Deferred Sales Trust allows you to do. You can time the real estate market by partnering with the trust and buying at a discount. In fact, we call the Deferred Sales Trust the ability to be the Monday morning quarterback, which in 2006, a gentleman did exactly this. He sold at the peak. 5 years later, the same property he sold was foreclosed on. And guess what? He used the trust to buy it back at 60 cents on the dollar, a 40% discount, all tax deferred, not using a 1031 exchange. That's where my brain exploded. I'm going, wow, this seems too good to be true. How can this happen? Well, once you understand each step, it happens, it works, it's perfect, but you got to get educated and you got to get engaged with what we're doing. That being said, Pierce, you want to add anything to the optimal timing aspect and also what you're seeing with luxury real estate down in the Newport Beach area?
Yeah, absolutely. So, I mean, the timing part of things is one of the, I think, the most key issues, because, not everyone gets to be the Monday morning quarterback and get that awesome, story, right? I mean, it doesn't happen every day, but it's because he was positioned correctly, right, with the right tools in place, that he was able to execute on something like that. He doesn't have a deferred sales trust. That doesn't happen, right? There is no story. So without it, it just opens up such a world of possibilities. And so it's just amazing in how that works. And, down here in Newport, we're starting to see, not a crash, but things are kind of reverting back to the mean as far as like housing prices and whatnot. And so, a lot of sellers are kind of like, man, like I wish I would have sold back at the peak, and try. And that kind of just goes to show that trying to time the market is really, really hard, especially if you're not in a place where you're liquid and you're able to maneuver. So, trying to sell a $10 million house takes time. It takes sometimes a month, 2 months, and whatnot. And so when you have these big assets, they're illiquid for a reason. And if you are in a position where you can capitalize on not paying tax, get liquid, and be able to maneuver, I do think that there is going to be some deals coming down the pipeline here soon. I think we're probably all in agreement with that. And having that time constraint of the 1031 is not where you want to be right now. So this is a phenomenal just pivot and totally better strategy than that.
Absolutely. Great job, Pierce. The next part of the deferred sales trust being an investment, not an expense, has to do with estate tax. So the ability to eliminate estate tax without giving it away to charity, without having to buy life insurance, without having to do any gifting, by changing the characteristic of your position, whether it be an owner to a lender. And you can do that on a sale of an asset. It could be cryptocurrency, business, real estate, really anything. But upon sale, we get it outside your taxable estate, which can eliminate the 40% death tax. So this is powerful, because if you're worth more than 22 million married or 12 million single, and all of your assets are inside of your taxable estate, you have an estate tax problem that the 1031 exchange does not solve, that a stepped up basis does not solve, but the deferred sales trust does solve it. So that's another way to make the deferred sales trust an investment and not an expense. Jake, you want to add anything else to that?
I think we ought to start making it real and go to the deal story of the week so that people can see how this works, Brad. I know that we've got a couple that we're working with right now. In fact, some of them, this is their second go around, right? Is there somebody that you'd like to bring up that we're working on with jointly, and we can start talking about them?
Yeah, I mean, we have one right now who's wrestling with using the deferred sales trust to just pay his tax. He's selling a business, about an $8 million sale, and he's wondering, should I just pay the tax? Should I just exit and make is the expense outweigh the investment? And part of it, he's looking at these different ways to invest the assets. And Jake, to be honest, like, is there any reason why you can't just invest it into different asset types that make sense for you?
Absolutely. So again, oftentimes we take people down a little bit of a journey so that they can make a conscious, deliberate decision about whether to use the deferred sales trust, to use other strategies, or just to pay the tax, right? In fact, we had not this client that we're talking about, but another one where they're from a very prestigious accounting firm. Their accountant was saying, well, this is a lot of work, and I'm just not sure, and I think you should just pay the taxes. And that was like a big light bulb moment for the client, who said, well, I think I need more advice. And we took them down this journey, because absolutely, Brett, what can people do once the transaction happens and they have all this money in the deferred sales trust? Do they have to go back in real estate where they came from? Or do they have to, in this scenario with the client and the $8 million, he's selling a business, right? What can he do with those proceeds? So this is where we come in. And Brett, with your background, you are an expert in commercial real estate. And with my background, with all other financial assets that people can invest in, from marketable securities, which is typically kind of like a default. And why is it a default? Because it's liquid. Because people can go in and out of marketable securities and be in control of the timing, so that should that next business deal, that next piece of real estate, or that crypto opportunity, or, you know, heaven forbid, they find a painting that they've been wanting forever, and for reinvestment purposes, it now can become an asset, right? So we can help these individuals buy, for investment purposes, anything that can show up on your personal or business balance sheet as an investment. And that encompasses a lot of different things, which oftentimes means that for the first time in their life, in this scenario of this individual with the $8 million business sale, all of his assets have been locked up in his bread and butter business. So for the first time in his life, he can actually diversify. He can have a little bit of real estate. He can have a substantial amount of money in the market, in marketable securities. And when the time is right, he's not being forced by any arbitrary deadline limitations. No 45 days this, no 180 days that. He can find, when the opportunity is right, that real estate deal or that other business opportunity. And we've really been able to help him open up his mind and make new objectives and actually have an investment plan that he never thought he could have before, because he didn't think he had that much control.
Yep. Fantastic. And as well as another deal, we closed a deal out of Texas, $8.5 million exit price, about a $5 million purchase for Jake and I. And the delta is about $3 million that he would have been owed on short-term taxes on. And we were able to structure the deal to exit in a way that it's been phenomenal for him. And they're just going to be rolling multiple deals with us now. And that's big. And part of that, he's very entrepreneurial and he's really real estate minded. And he was going to just pay the tax and not have anything that's diversified or liquid or in other real estate deals. And now he's got an extra, in this scenario, the deal was out of Texas, so it's a little bit lower, but still would have been higher because of the ordinary income tax. So it's about, 30, maybe a 35% swing, kind of based upon where he's at and the gain part of it. So on the 3 million versus on the 8 versus the 5, he's looking at approximately about $1 million, right? Extra to work with. Well, that's pretty cool. So that's the Deferred Sales Trust. So we talked about a little bit of the legality. We talked about how to make it an investment, not an expense. I also want to bring in the deal close fail of the week, right? Because we're talking about all this cool stuff, but now we have a fail. We have some, I think it's good to do on the other side. And this is more like what not to do. Two sellers selling about a $12 million business, okay? And they didn't do a lot of planning. In fact, they got into contract and they found us about 30 days ago, and they were in the 11th hour. And they said, hey, can we put this thing together? And now technically we could on our side, meaning that none of the contingencies have been, or not enough contingencies have been removed. There's still some contingencies remaining. So timing wise, we could do it, and we're spending time with them, and they're super motivated. B, they totally get the Deferred Sales Trust. C, they spend time with us and their legal team says good. But guess what? There's other parties that are involved. There's the selling, business M&A attorney that's involved. And then there's the buying attorneys that are involved, right? And this deal was basically, to the very end of it. And so we get on with the seller's attorneys. We're going through it all. That seems pretty good, although it seems like they're not that cooperative. They're not that excited. And could you blame them, right? I mean, they've done all this work and they're about to get this huge payday on a $12 million transaction. And this new thing is coming in that in their mind could derail them from getting paid because they only get paid at the close of escrow, right? And so you can't blame them. And then the buying side, but we think we got kind of through that. any of their concerns or challenges, but they weren't, let's just say, motivated to really do anything. And how do we know that? I mean, they were kind of delaying the communication with the buyers. They were saying, oh, we're cautious about this and we're not sure. And although we're saying, look, none of this has to do with them in that sense. We're just going to insert and add to the contract the assignment of your interest to the trust. And it literally is going to be the same document you use. It's just an assignment of sale. So it shouldn't really material change, maybe 1% of the actual purchase and sale agreement. In this scenario, it's called an APA, an asset purchase agreement. So we got through that. We're looking pretty good. And then the buyers group got a hold of it. And then we're not sure exactly what happened, but they basically said they're not willing to cooperate at this point and stage of the game. And so the fail of the week, these guys are going to pay about 35% on $12 million. And it's over, right? It's literally over. They're going to sell. It's closing. It's done. And they just told me yesterday, sorry, the buyers would not cooperate, and we don't want to lose the deal to the buyer. And what's interesting too is they went through a reorg for tax purposes to jump through hoops for the buyer by moving their interest into like a Delaware LLC, which was a better way for the buyer to come in to buy. And so they actually thought the buyer should be willing to cooperate, but they weren't. And so that's the deal fail to close story of the week. Jake, any thoughts on that?
It is difficult that it's not so much logic, or it's not so much the situation of the client that sometimes can prohibit the deal from going through, but it's oftentimes the people. And I'm not usually talking about the clients themselves, but as you mentioned in this scenario, in this circumstance, other people that had an ulterior motive or adverse interest in the outcome of the deal. And again, coming back to the education, coming back to the information, had these people had more time rather than just the month, I think they would have looked at the deal more closely, and they would have scrutinized the advice that they were getting from the other side in more detail. But because of urgency, and because they had perhaps months working with these other people and a very short time working with us, they kind of just took what they knew and they ran with it rather than learning something that could have been better for them. And I believe, and this has happened before, I believe that in a few months down the road, they'll probably come back just at least and acknowledge that things could have been better for them.
Yeah, and it's unfortunate. They were really excited to work with us. Everything was green lights on there, and something outside of their control in this sense, because they were late to the game with us. It's going to cost them millions of dollars for the rest of their lives and their children's lives, because it's not going to be deferred. And so it hurts. Those are the worst ones to go through, but it's a fail. And so what do we learn from it? A, be early, right? And this is a cool thing. Remember, we work on a conditional basis. If and when you don't, if you don't close the deal, the buyer doesn't come through, no problem, no owe us anything. 2, plan your exit plan before you actually sign the docs meaning with the buyer, or list the property, right? It's like start with the end in mind. I think Jim Collins wrote that book, right? And then Good to Great. And, one of those guys, or is it Peter Covey? Anyways, these really smart guys, right? Start with the end in mind. If your end is to, okay, I want to exit and I want to have this amount of cash flow coming from somewhere, start with the end in mind and plan, and then work your way backwards. So planning. You can never be too early with us. And then number 3, make sure that the team that you're working with who are selling your assets, right, have actually knowledge of the Deferred Sales Trust, right? And we have some of the best in the country that Jake and I work with: M&A advisors, business brokers, commercial real estate agents, luxury agents, escrows, attorneys. We have it all. And so you want to make sure that you're not working with blockbuster exit planners or blockbuster representatives who are using old methods that aren't necessarily going to serve you well. Like those are just only doing the 1031 exchange, right? You want the 1031 exchange and the Delaware Statutory Trust and the Deferred Sales Trust. You want all your options. You don't just have one. Same thing with M&A advisors. You want to ask them the question, well, how are you helping your clients exit in a capital gains tax deferral manner that's going to, help me on 40%? Because typically these are 30 to 50% of the gain is wiped out. So if you're selling a $10 million business, think about that. You're paying them 6% or even a 10% commission on some of these M&A deals. Wouldn't you want to know about the other 30 to 40% that's going to be wiped out at closing, right? I mean, technically you pay it the next year in tax. You don't pay it right at closing, but that's a big amount, right? And so if the people that you're paying, let's say 4, 5, 6, 7, 10%, if they don't know how to solve your 40%, guess what? The numbers don't lie. Those, you want to make sure that you're solving the 40%, not just hiring somebody to sell for a high price. So, Jake, any last thoughts on that before we open up for questions for everybody about anything on the Deferred Sales Trust?
I think we should just jump right in and see what there is. And if it's quiet and if it's crickets, then I'll add my 2 bits.
Cool. Anyone have any questions? You can put it in the chat. You can also unmute yourself and say hello. We can talk about a live deal. You can ask us anything you'd like.
Hello, I have a question.
Sure.
Hi.
We've got Corey. Where are you from?
I'm from Orinda, California.
Wonderful. Thanks for being here.
Great. Yeah. So I manage Legacy Capital Partners. We're a multifamily syndication group based here in Orinda, and we have properties in Sacramento. And my question is, how does this process look with the syndication? If you're selling a property that has multiple GPs and LPs on it, how does this process look?
Yeah, I'll touch on that first, and then Brett will fill in some of the gaps. Brett, who is obviously very experienced with all things commercial real estate, has, how would you say, a very hands-on approach to this. Let me touch on a few of the big differences. Should a general partnership or should a syndication go in and want to do a 1031 which is, a common strategy, a common tax deferral strategy, all members of the GP must participate, otherwise it falls apart and does not work. You've probably seen that before. Is that right, Corey? Oh, you're on mute for some reason.
No, I took myself off mute. No, I don't know if I have seen that. So you said all the GPs. So if it's us and we've got, co-GPs, what about the LPs? Or you just
as well? Okay. It must be equal amongst everybody. So it's rather inflexible. I'm just comparing the Deferred Sales Trust to other strategies that are commonly used, whereas everybody must be united and do the same thing with some of these other strategies. However, with the Deferred Sales Trust, this is individually based per household, per investor household. So if one GP wants to do it and the other one does not, or if the GPs want to do it and the LPs do not, all of that is customizable. In fact, Brett and I are helping three different syndications as we speak right now, who some of the investors have different wishes and desires. And the Deferred Sales Trust has been the tool that per household has allowed them to get out of this existing syndication and to get into other syndications, or as some of the scenarios based on some of the partners' desires and wishes are different. A couple of them are just going to pay the taxes and be done with the syndication altogether. So this has been a helpful solution to an otherwise murky problem where a lot of people wanted to roll over into the next project and some of the people did not.
Cool. And I'll walk you through that scenario, Corey, too, just so you know. I'm going to pull up my my whiteboard on my iPad Pro here, which is kind of cool. Get to draw a little bit. It's part of my artistic work. And I'm going to show you an actual deal that we closed for this. So just give me a second. And I don't know if you have any kind of numbers as well. Like, what's the adjusted basis? Is it an LLC? Is it an S corp? What's the debt on the asset? What do you have there? And that will also help us just be thinking about that. But let me kind of walk through. This is an actual deal we just closed about 30 days ago. Okay, so this is in fact, this particular client has done over $100 million with us so far, and they are very happy about the outcome on this $100 million worth of different assets. This one represents $48 million, and there was two main GPs. And for the first basically $50 million of assets that they sold, one in Arizona, another one in Vegas, and another one I think was in Colorado. They all had these GP positions, and they had a ton of LPs. And the neat part of the Deferred Sales Trust, and let's just put this big lump of LPs, they can all be paid, and they all go pay their tax. Like, they don't have to do the DST. In other words, the whole entity does not have to move. But for the GP positions in this $48 million deal, they assign their interest to the Deferred Sales Trust, so they didn't have to take the tax or have to take the gains at closing. Therefore, they're in a deferral state. And what's neat about each of their own DSTs, they can continue to add multiple promissory notes. So I'll put GP number 1, and they'll put GP number 2, DST, where essentially every time they exit, they just keep rolling in their gains to different properties, and they get actually a promissory note for each deal that they do to based upon their net proceeds. So it's one trust, multiple promissory notes, but it doesn't change the nature that the LPs get their money back and just pay their tax. That's all totally normal. That's totally easy. No problem. Whereas if you were to do a 1031 exchange, you're looking at the whole entity that must move, meaning everyone has to basically agree to go to one big 1031. All the money has to go here, and it has to go to one other big property that is worth 48 million or more, which can be difficult to find, right? Every time you lever up, you have to go more. So everyone has to continue to put it in, and it's typically one asset going into one asset. So you're neither diversified, liquid, or ready to go on your own. This is why most syndicators do not do 1031 exchange, right? And they just pay their tax. They also don't accept 1031 money because it's too complicated. They mostly just do the deal, sell, everyone pays their tax, and they come on to the next one. Well, what if you could have, and again, if the deal's big enough, we can do it with each LP. Each LP could have theirs. Let's just say they all had a million, at least $1 million, right? And then the big GPs here had, let's say, 20 million each, and let's say there's eight of these LPs, so there's about 8 million, okay? And let's assume they own it free and clear. Well, technically, each of them could have their own DST, and their funds could roll into each LP's DST, okay, in each of the GP, and then they could come back together later on, and they could all come into another deal together where they could say, all right, we found a $10 million deal, okay, and each of these DSTs with all the different partners could form LLCs, okay, and they could put some of the funds into one bigger LLC. So the DST, let's just say they all put 500,000 each. Now they would have paid, let's say, 300,000 or so. So they're using some of the house money here. And this 500 of these LLCs could roll into this, and the GPs put up the bigger amounts. Let's say they put up, I don't know, 2 million each out of their DSTs into this LLC, and they can buy this property all tax deferred. That's a powerful way to not have to do equal or greater value. Now, hopefully they bought this $10 million deal that was worth $12 million a year ago, and now it lowered to 10, so they get a $2 million, discount. Oh, by the way, they get a new depreciation schedule, okay, which is powerful. Whereas the 1030 has the old one, they get up to 80% of that depreciation schedule. If, this is a big if they're active, not passive, okay? So in this scenario, if the GPs were the only active members, then it's not likely that would work. But if we can all make these folks active in some way or part of the GP, then they can get a part of that. So it's a little bit depends on a lot of the scenario here. But is that making sense, Corey?
It does. Thank you. Any
questions on that?
No, that helped out a lot.
Okay, you're welcome. All right. Anybody else have any questions on anything I just said, or any feedback for Jake or I or Pierce? $1042. Okay. Jake, if people want to find you, what's the best place to find you?
strategictaxsolutions.com or 1-800-773-1848. We have a booking link on my website, or just come back here next Friday and see us together, right?
Absolutely. Pierce, if people want to connect with you, where can they find you? He's on mute.
So you guys can go to kingdomluxuryrealty.com. You guys have any property out here in Newport and you want to liquidate, Orange County, let us know. We'll help you for all your tax too.
Excellent. I want to thank everyone for attending and listening in or watching the replay of the Capital Gains Tax Solutions Deferred Sales Trust Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated real estate, business, cryptocurrency. Eliminate the need for the 1031 exchange so you can create and preserve more wealth. It works for crypto, business, whatever you have $1 million net proceeds, $1 million gain. We want to help you out. You can go to capitalgainstaxsolutions.com. We want to remind you of the book that's coming out very soon. Building a tax deferred exit strategy. We have people like Jake Miller, who you heard from in just a minute ago, financial advisor extraordinaire. People like Kevin Harrington from Shark Tank are in the book. It's going to be amazing. Would love your support to pick up the book, hear my entire story on the Deferred Sales Trust and how to build a Deferred Sales Trust or a tax deferred exit strategy. Look for that on Amazon real soon. Again, thank you for watching. Thank you for listening. You can go to capitalgainstaxsolutions.com. We can help you out. Invite someone next week, and we will talk to everybody again real soon. Bye, everybody.